First of all, the buy the high breakout strategy. So the theory behind this is buying the breakout the first day's high. It looks good. Eyeballing it, like I say, I've not really hammered the back testing, but it looks good. So what I decided to do is say, okay, well, why not if we use a stop of half of the first day's range? And I think that offers good risk reward. Like I say, before and after, I want to make as much money as possible with little risk as possible, but at the same time, I don't want to be stopped out on noise. So if we say we'll take half the day's range and we say, okay, that's your stop loss there. If you're going in at the break of the high here, as the price goes through there, the stop loss is going to be here, half of the day's range. Okay, so what I did is, and a target to be determined, but let's look at the data here. So I took Zynga, Groupon, Facebook, Twitter, Alibaba, GoPro, Fitbit. High of the day, low of the day. This is the first day, by the way. I should add that really. First day. The range of the day in dollars. Okay, so it's not percentage-wise, it's dollars. The midpoint, in other words, where you'd have your stop, what the stop value is going to be. So in other words, how far is it from the high? How far is the mid from the high? So that's the stop in value. Where did we go to? Now, high post break is where did we go to? What's the highest point after the breakout? Okay, in terms of dollars. So Zynga, the high was 1150, and subsequently the next however many days or months it was 1591. Groupon didn't actually break the high, so that's giving me a price at the high. Facebook, so and so. Dollars profit. Now that is in terms of dollars per share. So you can see the high post break 1591. The high was 1151. Take those away, and you've got 441. So that's your maximum potential profit. Now obviously we're not going to get the very high tick, but we're just using it to work a framework and get a framework on. And this RR is basically multiples of risk. So if you're risking the stop here $1.25 and you're getting $4.41 as a maximum, so the maximum risk, maximum reward is 3.5 times your risk. Now this is where it gets interesting, because 3.5 times is pretty good, 2.8 is pretty good, 8.1 is very good, 4.2 is pretty good, 29.2 is huge, as is 16.7. Your risk then on your GoPro trade would have been $2, and ultimately that thing ran up to $96 from 33, so you've got $63 potential profit. Now we know we're not going to get the high tick, but what we can say from this is there are many multiples of the risk potentially a reward here. So this actually seems a feasible strategy. So what I did then is I said, okay, that looks fine on those stocks. Let me just pick 7 IPO stocks at random from 2016. Literally gone dunk, dunk, dunk. Just pick them at random. Twilio, Trivago, Avexis, Protostatis, Syndax, Line Corp, SiteOne. I've not heard of most of them. Trivago and Twilio I know about. Now, each of these gave a profitable trade, many multiples of your risk. These 5 did. However, these 2 did not. You got stopped out on Line Corp, you got stopped out on Trivago. Now, bearing in mind that you're making many multiples, and I think on Avexis, it was a very serious move. Bearing in mind that one of these outdoes, if you're getting 3 times your risk, that's undoing all the loss from these 2 anyway. So it's actually, not only is it good from a perspective of probability of it being right. Now I know I've only taken 7 here, it's not a big sample size, probably need to take more, but including that with the other high profile IPOs, 14 IPOs picked out reasonably at random, it's working, looking good. So not only have you got the percentage of profit, the probability of profit being quite high, you've also got your risk reward ratio skewed in your favor, which is what I like. It's got a couple of things that have got going for it. So what can we conclude from that? The first thing is, what about further investigation? Let's look at that in a second. Let's just skip straight down to this point here. Right. Before I do that, let me just run through what I mean by the breakout strategy looking at the chart. So, for example, Alibaba, you would have taken, the 2 strategies are the buying of the first day break and the sort of 10 to 20 day dip buy. And both of those are reasonably profitable. There's the high of the day, so you're buying there. Your stop is going to be half of that first candle. If you can see, that's your stop loss there. Whoops. There's your buy. It's about a month later, and there's a nice risk reward there. Now, what I didn't go into is where you should exit. We'll talk about that in a very quick moment, But the point is, there's your entry. That's looking good, as is the 10 to 20 day dip buy. How do you time this 10 to 20 day dip buy? Again, this is a very loose and broad strategy, but it's something to look at. Facebook, the high was too late. I don't think you would have taken that. It's too far down the line. You want it in the first couple of months. The little dip buy worked okay, but I think you probably would have been stopped out, and as you pulled your stop to break even. Zynga dip buy worked perfectly, as did the first day breakout buy. And what else have we got? Let's move on to the other ones we had example of. Groupon never took out the high, so you never got involved in that. The little dip buy probably worked a little bit of profit there. What was the final one that we did? We did Alibaba. GoPro, absolute beautiful one. Breakout the first day and the subsequent dip buy, which we accelerated hard. Fitbit, again, first day breakout, good. Kind of messed around a little bit, but there's still profit to be had there. And the same with Twitter. The first day breakout around here, good. The dip buy, good.